Good morning, everybody. It's 8:30 a.m. Pacific Standard Time, 6/8 of 2011. Here, I have a weekly chart on the S&P 500. For all of the MMTs and our traders around the globe, is that we talked about this 10-week moving average on the S&P. We talked about 1 week ago that it took 5 3/4 months up until that last part of May where that reversal hit that high. It came down. We've had a counter rally to a lower high here. And once again, we got that major support level on this 10-week moving average right at that 1600 level. Now, they came in, they bought the dips on Jobs Friday report, as they did. That was one calendar day out of the first calendar week of June's trading that we had that one upside day. Things got on sale, such as Google. There was lots of stocks, such as BIIB. We'll cover that in a different setting. I am going to show here on a daily chart what this red line is. It's a very long-term constructive 50-day simple moving average on the S&P. It's been rising and rising and rising. Now, here is the counter gap from the jobs report on a daily view. One of the things that we're going to be looking at is where that 1660 is going to be a major wall of resistance. Now, the price volatility both to the upside for the bull and the price volatility for the bear is going to be there as well. When things got on sale down here, that undercut that 50-day moving average, but it's a long-term rising 50-day moving average. That means that every time that we've hit this in this calendar year, we have bounced like a rocket. One of the things that I would be happy to show you is between the weekly and this daily is that the 100-day moving average is down here right above 1560. Does it mean? It means that because of the way that this new bull run is in play, it's not like it was. We broke that bear trend mathematically. We are in a new bull. It's just the beginning of this new bull, and it's about, we started that bull run back in November of 2012. And we did have some selling that represented last week on some of the reversals where the bears were in control. We seen a repeat in the actual directional movements that we seen in November of 2012 on these last dips. From every time that we hit, equities were selling off. We found that support. It's called a bull rally relief. What we're going to be looking for is a lower high. What I am going to tell everyone very specifically, it's going to be extremely hard to take out these tops in this particular run. And usually after a good correction, we get about 10 good days. That's what and I'm going to show a monthly chart. This is just a monthly reversal up here. You can see those dips come in right here, but look at the long-term monthly structure. On the weekly, once again, that 10-week is a very long rising 10-week moving average that you see in bulls. Before, when we were in bears, well, we all know that all of these key moving averages would be sloping down, descending in value. We're not in that environment. People came in, they bought that major dip at that first correction. It was only 87 handles. It got right here to 1600. That's that half bar. The underlining support is always going to be, whether it's a 10-day moving average or these weeklies, it's going to be this one right here. This is where you would have another relief rally and another big relief rally for the bull. So we haven't fully corrected. People bought that dip. They think the economic data is getting better. We have our own analysis about that. That's not to be done here. However, I'm going to conclude that the S&P has that first bounce. We're going to be looking at the 1660. Another thing is that the high that comes up here would remain a lower weekly high than this last weekly high. Equities themselves in the S&P 500, if you go back a week ago videos, you'll know, MMTs, that every stock, the price volatility, it's going to hit the upper end and they're going to sell off. That's the S&P 500 on a weekly chart. This is the S&P 500 with the long-term rising 50-day simple moving average. The upper end of the resistance is where we're going to see where this bull would have failure again. It's the first calendar year correction that we had. Everyone was expecting that reversal to come May 1st, walk away May and come back in November. Price volatility over the summertime is going to increase. It's here to stay. So, in both directions for the bull and the bear is going to get its share of price volatility on reversals, and then the bull is going to come back. As strong as that bull is, the mentality of the general consensus is still to buy those dips. Buying and trading the good quality stocks is what we're going to focus on. There'll be easy money to be made next week, and we'll go over individual plays. We'll get all our options set up. We'll do everything it takes. I'm going to conclude the S&P 500 daily and weekly long-term bull trend. This is a bull trend. And so, I told everyone last week that they were going to use Friday to squeeze the bears. That bear trade was a good trade. But listen, that counter rally takes the bear out, makes the bear buy to short cover, takes these things up higher to resistance levels, and the economic growth isn't that great. So don't worry about it. This is all about how the trade management's going to work and how the price volatility is here to stay throughout the summer period.